Index funds are popular investments and there are good reasons for that, but I often see people misunderstanding some of the risks you take with index funds, so let's talk about that. In this video, we'll briefly review how index funds work, what some of the risks are, and then how you can manage those risks as you use these instruments. A key feature of index funds is their low cost, and since high expenses mean you end up with less money later, then the lower your expenses, the better, all other things being equal. With an index fund, you're typically going to have a relatively low annual expense ratio, meaning you pay very little for the management. The tax costs of owning an index fund can also be quite low because they have relatively low turnover, meaning they're not buying and selling investments quite as frequently as a lot of active funds, and that means you don't take capital gains as often. When it comes to investment strategy, index funds are what's called passive investments, so you don't have a manager or a management team that's trying to pick which investments are going to do the best and which ones to avoid, and that way you're not paying for that team and paying for all their travel and all of the other expenses that might come with active management. The fact is that very few investments have off-the-charts performance, so you might be able to think of some big names and maybe you want to find the next Amazon or something like that, but it's very difficult to do that. So by owning lots of different investments, you improve the chances of being there for those few that do extremely well. Just a friendly reminder, this is just a short video. It can't possibly cover everything you need to know, so please do a lot more research, and I highly suggest checking with a professional to get individualized advice. So index funds can be an excellent choice for investors, but something that confuses people is maybe because they hear so many good things about it, they might even hear that they're the best type of investment or that they're the safest investment. And the safest part in particular is something I want to talk about in detail because you can actually take quite a bit of risk with an index fund. It's kind of like saying that salsa isn't spicy. Sometimes it is and sometimes it isn't. It just depends what you have inside of it, and the same is true for those index funds. An index fund simply tracks an index or a grouping of stocks or bonds, but this grouping typically has some common characteristic. So it might be 500 of the biggest companies in the US, for example, which might describe the S&P 500. So if whatever those securities are happen to be risky and they will go up and down a lot, then so will any index fund that tracks it. When it comes to stocks, you can certainly lose money by investing in stocks, also known as equities. You obviously do that hoping that you will get some long-term growth, but historically we've seen that you have to put up with some ups and downs along the way. Let's look at an example of that. So if we go back to the Great Financial Crisis, this is around 2007, 2008, the S&P 500 index was down about 38% in calendar year 2008. In fact, it was down more than that at some point during the year, but it ended the year down 38%. Mutual funds that track the S&P 500, like S&P 500 index funds, also lost a similar amount. So the category average during 2008 was negative 37.8%. And what we're looking at here is just a typical S&P 500 index fund. So I'm not recommending for or against any particular fund or fund family. This is just an example for illustration that shows you what happened with the average S&P 500 fund regardless of the issuer. They were all roughly like this. There are many other indices or indexes out there that you can use to track stock and bond markets and other areas of the markets. So you have the Russell 2000, which is smaller companies in the US, or the Wilshire 5000, which attempts to track all of the companies in the US. But the point is that there are a lot of different measurements you can use to track these different market sectors. And so, for example, you might ask about bond index funds. Are those less risky? And traditionally, yes, bonds are viewed as less risky than stocks, but they can certainly lose money. So if we look back at 2013, for example, that was a year when bonds lost some money and the losses were not as great as you might see in some of the worst stock market crashes. But if you go with the assumption that index funds and bonds are safe, then you would perhaps be disappointed and surprised. So if you do want to manage risk, then you can add in some bonds to your portfolio, but you want to maybe think about using shorter term and higher quality bonds because those might have the lowest risks when compared to long-term bonds or junk bonds, also known as high-yield bonds. But what you need to remember is that there's no such thing as a free lunch. So if you're going to go for safety, you might end up getting lower interest rates and returns from your bonds. It could work out well, or it might work out not so great. It just depends, and this is part of being a long-term investor, that you have to accept these trade-offs. What's more, it can get really complicated as an investor. So as just a quick example, we can look at during 2020, roughly 5 stocks made up about a quarter of the S&P 500. So you might have thought, I'm in the S&P 500, I've got exposure to 500 different issues, but in fact, about a quarter of your portfolio in that fund would have been roughly 5 stocks. That's just a feature of how the S&P 500 is designed, and it has pros and cons. It happened to work out well if you were along for the ride that whole time because those 5 stocks did quite well. But depending on timing and other factors, it can sometimes not be ideal for investors. There are other index strategies that can get convoluted, and we're not going to get into that, but just want you to be aware of this type of thing. Given all of that, you might wonder if I'm saying that index funds are bad, and that is definitely not the case. In fact, I use them quite a bit when I build portfolios for clients, so I just don't want you to get caught by surprise if you're thinking that you're not taking much risk in a stock index fund or even a bond fund. If you found this helpful, please leave a quick thumbs up. That's a signal to me to keep putting out information like this. So thank you and take care.